Welcome to 11 a.m. You are live, sir.
Thanks for having me, guys. Great to be here.
Awesome. So I think I could connect it to you through James, who's one of our earliest supporters, and I think was working with you for a while. And I just remember being like, oh shit, there's a whole big world out here. And this just seems like the most obvious opportunity, and yet it had not come across my radar at all. And to be fair, I'm not the LP guy here. Josh is. Josh just loves to go provide liquidity and have a good time. But maybe before we dive in, because we have got some specific questions, can you just give us a sense of where the idea for Turtle came from, what it is, and kind of some of the progress you guys have made over the last year or so?
Absolutely. I came up with the idea of Turtle back in 2021 while I was working as a CFO for Omnisha. It's a smart contract auditing shop. So I was doing doing a lot of BD on the audit side, risk assessments, tokenomic modeling, protocol design, and really helping a lot of founders back then and kind of advise them on how to better distribute their incentives to better align the incentives between their stakeholders. And I wouldn't call that like TVL deals or TVL campaigns necessarily, but there was a strong component of that within the tokenomic modeling work that I did back then. And then I was also working for a company called Web3 Cloud. At the time, they're one of the large GPU miners, a joint venture between Consensus and AMD. And I was working as like a director of DeFi for them, helping them deploy some of their digital asset balance sheet in these different DeFi protocols. So I was working on, I guess, both sides of the LP spectrum. One was actually deploying the liquidity myself. And on the other side, I was trying to quantify risks. And yeah, the underlying idea came about when I was trying to essentially figure out a way to better deploy the liquidity on behalf of my clients or just kind of friends that I know in the space. And the whole idea of Turtle, kind of one of the premises that I had was that if I wanted to continue competing like at the highest level within the LP game, I needed to start growing my scale in terms of the amounts of liquidity that I can start tapping into, because the more liquidity you have, the more collective bargaining power you have, the more what I notice is the more willing different projects were to kind of offer myself and my community like just better terms.
Right. So
In
that's
other
kind of
words,
the core idea, right? Is that you have a whole bunch of capitalists looking to go provide liquidity. So you've aggregated that together, and then you're able to go out and get additional incentives to direct that liquidity to certain places that any of these individual actors wouldn't be able to get, but on aggregate actually meaningfully increases the APY or value that LPs get. Is that correct?
100%. So that's on the upside. So the whole idea of Turtle is not to necessarily generate the highest APY possible or take on the most risk possible. It's about trying to deploy liquidity in the most efficient way possible and moving liquidity in with least friction. And the way you do that is by essentially increasing the yield that we can offer our LPs, whilst at the same time tapping into that scale or that liquidity base so that we can do a lot of the due diligence and try and protect our LPs as much as possible. And due diligence, when it comes to risk, is quite complicated and quite expensive in the space. You have obviously the technical risks of the smart contracts, operational risks of how the team kind of operate internally and or secure kind of the keys of the protocol. Then you have compliance risks, financial risks. Are we subjecting LPs to liquidation risks or impermanent loss, etc.? So there's just a lot of different types of risks. And what I found out on the auditing side is everyone loves due diligence, but no one likes to pay for it. So the idea on one side was to leverage that collective bargaining power to get the best upside. But then on the flip side, it was how can we essentially build such a big scale so that we can absorb the due diligence cost on behalf of our LPs. And there is a variable component when it comes to due diligence, but in a way, the costs are somewhat fixed.
Hmm.
So the idea is because we're absorbing the fixed costs on behalf of our LPs, we can, by spreading that fixed cost over a larger liquidity base, now we're in a situation where we can offer LPs better yield on the upside whilst exposing them to less risk. And then based on how I designed Turtle, the idea is that it's a non-custodial protocol where we track the activity and wallets of our users rather than building an additional smart contract layer on top where our LPs need to trust us. So if I were to knock my head and turn evil today, or if I were to be hacked, none of my LPs funds are ever at risk. In other words, we increase yield, we decrease risk, and we don't add any additional counterparty risk into the stack ourselves. And that's how we're able to, I think, offer some compelling risk-adjusted sort of opportunities across the risk curve in Web3.
Yeah, so I'm seeing $588 million in TVL and from 16,000 plus LPs. And then I also see a Dow Treasury here of about $8.3 million. So can you talk about just what is the business model for Turtle here? How are you guys making money? And I know you guys had a token launch recently as well. So very curious about how that economic model comes together.
Absolutely. So we charge either a revenue share and or like a flat fee on TVL that we route and push to the different protocols that we work with. However, historically speaking, yeah, we've kind of had a bunch of products that we're kind of developing. And I think our API Boost product, that was the one that had generated us the most revenue to date. And we take a percentage of the emissions that our clients, or in this case, protocols, end up
Okay.
distributing to our LPs. So the treasury is, we actually have more money in our treasury. We're just, kind of seeding one of the new vaults that we're launching soon with some bigger players in the space. And then we have a couple of like off-chain deposits and stuff like that. So we should have roughly around, give or take, $15 million in the treasury today.
Can you give me a sense of what the pitch to these protocols looks like? I imagine it's like, are these people trying to bootstrap TVL to gain trust? And then the idea is that there's kind of a big halo effect from having larger TVL, because I assume once these campaigns end, the liquidity that you guys bring is going to rotate elsewhere.
Yeah, there's definitely a lot of mercenary capital in the space. I mean, there's different kind of phases and ways protocols can engage with us across the stack. Some protocols, they just want us or our LPs to try out their protocol. And in that case, it's not a very hands-on engagement. They just want us to share their liquidity deal or offering with our community. And then that's kind of about it. Whereas with other protocols, we act as kind of ecosystem builders. So I would kind of break the work we do into several different phases. The first phase is mainly just to get LPs onto our clients' protocols in an economical way, more of a marketing expense. Whereas phase two is we are kind of working with different chains or protocols, asset issuers, hand in hand to try and build out more utility integrations, use cases within their chain or protocol that will allow us to kind of offset some of the kind of fall in emissions expenditure as time goes on, and then generate some more native yield that we can then pass that on to the LP. So also, depending on the different types of assets that the client wants us to provision, or the different types of LPs across the LP spectrum, the cost of capital can be very, very kind of different or can vary a bit. Like on one side of the LP spectrum, you have liquid funds, which are, in my opinion, with market makers, the most sophisticated players in the space when it comes to LPing. They have a really good overview of the different yield sources, opportunities in the space. As a result, they just generally have a higher cost of capital because they're better at deploying liquidity on average. And as a result, if the hurdle rate or the yield falls below their hurdle rate, they're also much more willing to kind of move their position into the next best opportunity. So whereas if you go down the LP spectrum, right, you get ultra high net worth individuals like private banks, family offices, and a much longer tail of medium to retail LPs that aren't as active. They just want to kind of deploy their liquidity in a way that doesn't expose them to too much risk and be less hands-on with it. And these types of LPs tend to be more sticky and have a lower cost of capital. Saying that, there's just always a intense competition for liquidity in the space. So everyone wants liquidity. Those that have it want more of it, and those that don't have it need it desperately. So there's always a continuous kind of market, bid. All of these protocols essentially trying to outbid each other. And then another important point to consider is just like the different types of digital assets in the space as well. Like stablecoins, in my opinion, is by far the number one like digital asset class, let's say, that these protocols are most interested in. So the competition for stablecoin liquidity is really fierce, which is why the cost of capital on stablecoins is generally 2 to 3 to 4x higher than it is on, let's say, Ethereum or Bitcoin. So really part of our job is trying to connect the right types of stakeholders with the right types of LPs. And also, go ahead.
Well, so you guys launched a token earlier this year, and we here at 11 a.m. have an 11 a.m. strategy. We use our trading fees from the token for this the show on Zora to buy tokens. So we were looking at the Turtle token, and very interesting to us is that you guys as sort of a liquidity provider are very, very heavily in sort of indexed on the centralized exchange listings over dexes, and I think the deepest liquidity is over on BNB chain. So I'm just kind of curious about how you thought about building liquidity for your token specifically, and why you chose the venues you did.
Yeah, that's a great question. We're very aligned with the Linear ecosystem. They've been great supporters of Turtle, kind of helped us bootstrap Turtle. So the idea was always to kind of have a liquidity pool on Ethereum mainnet and Linear.
Okay.
And then kind of as part of listing on Binance Spot, we also launched a pool on BNB chain as well. Again, I don't want to get in trouble in terms of like legalities or something like that, but yeah, we are going to shortly kind of propose a new sort of governance proposal that will kind of allocate some of the protocol fees that we generate to start seeding and directing more liquidity into our own protocol-owned liquidity pools. I'm a big fan of owning the liquidity ourselves rather than kind of renting it and paying like extortionate amounts of APY and diluting all of my stakeholders. So I like what Ethify did with kind of their buybacks and essentially putting money in their own protocol and liquidity pool as time goes on and building more of a liquidity depth. Frankly, we should have done already a bit more work on that side.
Well, I'm curious.
Too many things to do. So
the thinking around doing a centralized exchange listing in general I think it looks like that's how you brought it to market, versus kind of bootstrapping. You seem like you're right at the nexus of, and you have aggregated the hardest part of actually doing a DEX based token launch, which is you have liquidity providers and people who, and a business. So what was sort of the math or strategy behind doing a SEX listing first token launch?
That's a great question. I mean, I'm a bit of a DeFi maxi, so in theory, I should be much more aligned.
You're not a DeFi maxi if you're not launching your token YOLO on DEXs.
Well, that's the thing, right? In theory, I should be doing that.
Yeah.
So the question is, okay, why did I contradict myself? Honestly, I thought we were going to do one. I was speaking to a number of the sexes for over 12 months, so quite a long time. And there is a big trade-off in terms of and cost, to be honest, to list on a lot of these centralized exchanges. So, but I felt, given that we are a liquidity protocol and we are building, really strong connections with many of the biggest liquidity hubs in the space, whether that be, protocols or market makers or LPs, investors, etc. And kind of one of the biggest liquidity hub in the space is Binance. So I think for us as a protocol, given that we are a liquidity protocol, the importance of plugging into the biggest liquidity hub in the world was, kind of the last big connection that, frankly, we had to make. And saying that, I mean, we negotiated, frankly, very competitive terms with Binance. I think, they gave us a very good offer, so which I wasn't expecting. So I'm frankly quite happy with listing on Binance. I think they added a lot of value to Turtle, and also we got, I think, around 50,000-60,000 new users from them.
Okay.
So in the short run,
that
will have I guess, an adverse effect on the price, because you do have to give a hodler airdrop to BNB stakers or whatnot. But I think we did get quite a bit in return, and as a result, I think the ROI was actually quite positive for us.
Yeah, that's interesting. I think the reason to do it is to tap into the huge user liquidity base, and I've always been skeptical that it actually translates into any real increased adoption for your product. But great to hear that like 50,000 new users from doing that is huge.
Yeah, I do agree with that statement. Well, I mean, and this is the kind of conversation that I have with my clients as well. It's like, look, I can bring LPs to your protocol, but if your products or services aren't competitive and they're not willing to use it without getting ridiculous subsidies, then you really haven't built a really strong product or service or business.
Yeah.
So, I think the same kind of applies to a lot of these protocols, frankly, that list on centralized exchanges. We were fortunate that we were in a strong position financially that, we don't need to dump our tokens or do any of these OTC sales to try and like build a bigger runway because we're burning a bunch of money. For us, that wasn't never the case. So, we never, dumped a single token or engaged in any OTC sales or anything like that.
Yeah, I think it's just there's so much nuance to all these decisions, and most people's exposure to them are on, crypto Twitter or whatever, which completely lack all that nuance. So yeah, I appreciate that answer.
I mean, maybe, quickly, a self-interested question before we let you go. So I think it's something I've been wanting to use for a while, and just my laziness has overcome me, but I'm now motivated to go try this. But like just looking at the site, it's kind of hard. You see, 15 different campaigns I could potentially participate in, a bunch of varying APRs. Like, how should I think about my usage of this platform and like where I should deposit?
That's a great question. Honestly, we spend most of our time and resources on dev, but we haven't shipped around 85% roughly of kind of what we've developed so far. So the application is still, evolving a lot and frankly quite quickly. I think Nick has done a great job on that. But in the way the application is going to work, we have a consumer-facing application. Think of that as like the Turtle app today. So very soon we're going to launch a dashboard similar to like the bank, but maybe just a bit more sophisticated, which will allow our LPs to amalgamate all of their addresses, not just even on sort of EVM, but potentially also on Solana or some of these other non-EVM based chains, into one portfolio page, so they have a better overview of all of their crypto positions rather than just one address. And then the idea is to also allow them to track a lot of their non-crypto based TradFi positions, whether that be stocks or ETFs or whatever the case may be.
Really?
So
I mean, Josh, I thought where you were going with this, Josh, was like, just give me a pool to put it in and show me a decent APY so I don't have to worry about it. But it sounds like you guys are going in the like prosumer power user direction here.
100%. What I've seen in the space, especially over the last 2 or 3 years, is that most of the value accrual is going up the stack towards the types of applications that have a larger control and influence over the consumer. So what's the first thing that I do every morning as an LP, right? I go on the bank and check out my portfolio. And especially, the more active participants in the space, we're always looking to rebalance and redeploy our liquidity in other, better positions. So the idea is that because we're amalgamating now more LP data, whether it be on-chain or off-chain data, then I'd say, from my understanding, like anyone else in the space, but I could be wrong. The idea is to analyze the off-chain and on-chain data that we have over LPs, and then make like really good risk-adjusted recommendations to them to say, hey, look, this opportunity was good 2 months ago, but now the stablecoin vols or strategy has, the APY has gradually fallen below your hurdle rate. We currently have 3 or 4 deals, in our sort of database that actually have a higher return and or similar risk profile, or actually less risk. So why don't you transfer your position from this underperforming position to this new vault that we're launching, for instance, or this new liquidity campaign that we're doing. So one thing is about kind of just helping the LP track and manage their portfolio and LP positions, and continuously provide them with like data-driven opportunities that would be interesting based on their mandate and profile as an LP and their risk preferences. And then we have a second app, which we haven't announced yet, which is, we call it like our client portal, more of a B2B app, which allows our, whether it be clients like chains, asset issuers, infrastructure companies, dApps, etc., to kind of run a lot of these campaigns. So we've built out over the last 19 months, we've made a lot of progress on our indexing infrastructure, so we can now distribute incentives or help our clients distribute incentives efficiently on chain in a data-driven way. We've now built out our own Web3 CRM, which can communicate with our LP database that we have. It interacts with TG. So the idea is essentially we're building out a lot of the tools and stack necessary for protocols to better conduct these types of TVL campaigns in the future. I think of it as like trying to build out the future of on-chain banking products and services.
Awesome,
And
man.
yeah, we should be able to share that something like publicly within the next month or two at the latest.
Awesome, man. We got to leave it there. Very interesting. Yeah. Yeah, interesting. Putting your head under the water of a whole segment that is obviously a lot more deep and nuanced and big, and yeah, very interesting conversation. Appreciate you hopping on with us, Essi. Send Josh a link once you have the power user tool here. He loves to do this. You guys, a Meteor, a bull over here. So if you can pull him back into some other ecosystems with better APIs, he's mercenary. The guy's pure mercenary capital. I mean, are you mercenary?
No, I'm missionary. I'm here to provide value.
Yeah.
I mean, I'm quite mercenary myself on my PA account, I have to admit. And but I have to say, the mercenary guys, they're usually the ones that are deploying first in these deals. They're taking on more risk. They're also committing to a high set of standards and committing to, leave their
everybody's missionary because we're just using shit on chain, but we're mercenary to survive long enough. Essi, thanks for hanging out, man. We got to let you go. Best of luck as you guys bring this product.
Thanks for having me, gentlemen.
Cheers, man.
Cheers.